Okay, good morning and good afternoon. I believe you have all joined us online now. Welcome to this Bruegel event on green finance and the EU Green Deal. My name is Alex Lehmann. Let me briefly introduce the topic and our speakers. So this is an issue which internally and with our members and our partners in Brussels and elsewhere in the EU, we have followed for several years now. The Green Deal is an ambitious investment program that relies in good measure on private financial markets and investors in identifying, structuring, supporting green investments. Today, we really want to explore the linkages between the financial agenda and the ambition for a low carbon transition in Europe and elsewhere in the world. This is a substantial investment program, and it's clear this will not be supported by public funds alone. We're really delighted to have an expert panel here. Let me briefly introduce them and then turn over very quickly. We're really pleased to have Klaas Knot, President of the Dutch National Bank, with us to give the introductory keynote speech. Now, DNB has, of course, been at the forefront of the financial agenda around climate risks and green financial instruments, and has really spearheaded and supported this agenda elsewhere in Europe and at the ECB, importantly. Really looking forward to your comments, Governor Knot. And we will then have responses from Isabel Mateos Ilago from BlackRock, where she is a managing director in the official institutions group. And needless to say, her institution too has been very public about their changed expectations of investee companies and in their portfolio management. I think we look to you to explain the ramifications of the financial and policy agenda for a large asset manager such as BlackRock. And then to round this off, we will have responses and comments from John Kidney, who heads and has founded the Climate Bonds Initiative, which has been really the main driver in defining green debt instruments for capital markets, has been active throughout Europe and in many emerging markets. Now we're especially keen to see how the UK engages with the EU agenda with things like the Green Bond Standard coming up. And then we will conclude with a comment from Philip from Restorff, who joins us from Luxembourg, where he is with the Luxembourg for Finance Initiative, and that has been shaping the local exchange as a green finance center in Europe. So we're keen to see how local exchanges can support this agenda. So briefly, we will kick off now. The questions, please ask through the website. And you need to go to sly.do and enter the code sustainable. And I will then see these questions, group them, and put them to the individual panelists. Governor Knot, over to you. Thank you.
Thank you so much. It's really great to be able to speak here. I mean, over the years, I guess Bruegel has become synonymous with excellent and policy relevant research. It's the kind of research that makes officials like me hopefully do a better job. And I'm glad to see that this is also recognized by others. Recently, the 2020 Global Go-To Think Tank Index report was published by the University of Pennsylvania only 2 weeks ago. And in that report, Bruegel ranks as the #1 non-US think tank in the world. I would say that's truly worthy of congratulations. And in that vein, I'm quite pleased to see that Bruegel is now also taking forward the important subject of sustainable finance. And for me, obviously, from my perspective, also the role that authorities will have to play here. So let me start by taking you back roughly 30 years ago, when Europe stood before the great economic challenge of that time, and that was transforming the crippled communist economies of Central and Eastern Europe into modern market economies. When I worked at the IMF in the late 1990s, in our reports, we referred to that group of countries as transition economies. Well, as Bruegel has already pointed out, 30 years later, we're all transition economies now. Not only must we make our fossil-based economies carbon neutral by 2050 to prevent catastrophic climate change, but we must do so while recovering from a public health and economic crisis. Now, I focus on climate change, but the challenge, of course, is really much broader. It includes all forms of environmental degradation that make our economies unsustainable. Europe's Green Deal tackles these multiple crises head on. It's ambitious, it's comprehensive, and it focuses on growth. And with the next generation EU recovery package, and with the reinforcements to the EU budget, it is backed by unprecedented public financial firepower. The new sustainable finance agenda that is coming out soon will likely provide plans to mobilize much needed private investments. And that's exactly why the best economic response to the COVID crisis is to start implementing the Green Deal as soon as possible. After the Euro crisis, after Brexit, Europe is now leading the way, which makes me a proud European today. But true leaders not only show the way, they also make sure that everyone is on board. The introduction to the European climate law proposal states, and I quote here, "The European Green Deal reaffirms the Commission's ambition to make Europe the first climate neutral continent by 2050, end of quote." A laudable goal in and of itself. But frankly, it would be even much better for the planet if by 2050 we were the last continent to become climate neutral. Because that would mean that other nations have caught up with us and even surpassed us. And then the whole world will have become climate neutral before the crucial 2050 deadline. I'm optimistic that Europe will team up with the new American leadership, possibly with China and India and others, to form the powerhouse, the engine that gets the world back on track to meet the Paris Agreement. Because in order to get the energy transition really done, we will need to work together in many, many areas. Because, and that's the point that I'm trying to get across here, there is no European, no American, or no Chinese climate problem. There's only a global climate problem. Now, let's go back to Europe. As we all know, getting the European economy sustainable for future generations requires large investments. A big part of these investments need to be made by the private sector. And for these private investments to scale up sufficiently, and for the financial sector to finance them, we need to get the right conditions in place. So what needs to be done here? And what can governments, central banks, and supervisors do? That is, of course, what I want to discuss with you today. First of all, we need a better business case for green investments. And one policy instrument is absolutely key here. And that is to raise the effective price of greenhouse gas emissions. Carbon emissions are the main, but not the only contributor to greenhouse gases. You see, I'm an economist. Some may call it naive, but I have this firm belief, backed by experience, that for economic transformation to take hold, you need to have the relative prices that reflect the true scarcity of economic resources. In this case, by pricing in the climate cost of greenhouse gas emissions, by internalizing the externality. And that will make it far easier for firms and households to determine the future value of their assets and liabilities. This will alter their incentive framework, and then market forces will drive things in the right direction. This ball, of course, lies squarely in the courts of the governments. The EU Green Deal sets out ambitious plans to make carbon pricing more effective, and it is crucial that these plans are not watered down. This is the one thing that makes all the other things that we do much more effective. Secondly, investors and the financial sector need clear and credible transition plans from governments. A plan that provides answers to questions like emission targets will be met. What actions are necessary to achieve these targets? What regulation is going to be implemented and in what sequence? What investments will the governments make themselves? And how are we going to compensate vulnerable groups? In answering these questions, we can draw lessons from the economic transition 30 years ago. For example, I recall the debate about gradualism versus cold turkey. Some reforms, like changing prices, you may have to do as quickly as possible. Cold turkey in order to avoid a warm planet, one could say. Others, like changes in productive capacity, will of course take more time. What's also important is that it should be a plan that will still stand in place after the next election and after the then next election. A plan that gives investors a sense of where we are going, that offers perspective, provides opportunities, and reduces investment risk. Here again, I think the Green Deal goes a long way in fulfilling this need for a comprehensive plan. And now we have to enshrine it in law, work out the details, and get it implemented. Apart from carbon pricing and having a plan in place, what else do we need to do to get the money flowing where it is green? Well, and thirdly, banks, insurance companies, and pension funds need to be more aware of the climate risks that they face and manage these risks accordingly. Financial institutions are vulnerable to the physical consequences of climate change. Just ask insurance companies. And as I said, it is broader than just climate change. In last year's report called Indebted to Nature, we at DNB showed that Dutch financial institutions alone have over €500 billion in exposures to companies with high or very high dependency on a well-functioning ecosystem. Companies whose business may be at risk due to biodiversity loss and other forms of environmental degradation. Financial institutions also run transition risks. For instance, the bank loan provided to a car manufacturer may be at risk if it fails to develop and build clean vehicles that meet new energy regulations and changing consumer preferences over time. So climate risk is a new and important driver of financial risk. Financial supervisors must push financial institutions to manage these risks accordingly, just as they do with other risks. Pressing for good risk management stems primarily from our mandate as supervisors to keep financial institutions safe and sound. But there is also an important byproduct here. Once these institutions have a better understanding of the impact of climate-related risks on their balance sheets, this will also impact their investment decisions. Less money will flow to fossil fuel investments and more to green investments. And this way, financial institutions can also become a powerful force in pushing the green transition. To be honest, I have not yet seen clear evidence of this reallocation effect playing out on a significant scale. For one thing, it is difficult for banks and other financial firms to manage their exposures as long as they lack good information about what is green and about what is not. And that brings me to my fourth point, and that is disclosure. The information that the financial sector uses is only as strong as the corporate disclosures it is built upon. And that is why the quantity, quality, and consistency of corporate reporting on sustainability-related information must improve. Credible and comparable information should be readily available for all market participants, shareholders, and other stakeholders. And also this calls for a global solution. I believe the reporting of such information is most effective when it is aligned with the requirements of global accounting standards, and therefore reflected in the audited annual accounts of companies. This also ensures a level playing field across jurisdictions. I think the International Financial Reporting Standards Foundation, the IFRS, is best positioned to set such standards. And therefore, I'm happy that the IFRS has recently announced to take steps in that direction. Europe, as a frontrunner, has a key role to play in making this global effort succeed. The Italian G20 presidency has asked the Financial Stability Board to explore how progress can be made here based on the recommendations of its task force on climate-related financial disclosures. Finally, European capital markets need to supply more risk capital. At the moment, European firms mainly depend on banks for their funding and only to a limited extent on capital markets. They only have limited access to private funding markets, which are very small in the EU, at least compared to the United States. We need European financial markets to supply more diverse types of risk capital needed to fund the energy transition. Risk capital that typically comes from venture capitalists, private equity funds, and investment funds. And we also need to do something about the existing carbon bias in European capital markets. In that respect, I think the European Commission's action plan for the Capital Markets Union could be further improved by stimulating better access to risk capital for green investments. At the same time, funding of non-green investments will have to become more expensive. Apart from carbon pricing, better disclosure, again, is key here. Once it becomes clear for investors that a company's footprint is not sustainable, risk premia will rise. Central banks can also help to correct the carbon bias in capital markets. In the euro area, the European Central Bank's purchases of corporate bonds follow a market neutrality principle. And this means that the purchases reflect the broader corporate debt market. But what does this neutrality mean if there is a carbon bias in European capital markets because the relative price of carbon emissions is distorted? Central banks could explore how, within the boundaries of their mandates, they can redesign their monetary policy instrument to prevent such biases from occurring and instead contribute to unlocking more green investments. We could take the existing EU policies, such as the Non-Financial Reporting Directive and the EU taxonomy for sustainable activities, as a starting point in this respect. I spoke about the need for carbon pricing and transition plans, about the need for good risk management and disclosure, and the need for more supply of risk capital. When it comes to the role of the financial sector, I may have inadvertently left you with the impression that finance always follows the real economy. That if governments and central banks and other policymakers and standard setters provide all the right conditions, then funding for the green transition will follow suit. Although I do think that this is largely true, it's not entirely how I see the role of the financial sector. Financial market players should not wait for all the regulations and conditions and perfect data sets to be in place before they can have impact. They perform a crucial role in the economy by helping companies to grow and create jobs and wealth. And that means that they have a social responsibility of their own to make sure that their business models support a sustainable economy. It is good to see that many financial institutions are working on reducing their carbon footprint. To them, I would say, keep up the good work and branch out where possible. And to others, I would say, don't just talk the talk, but also walk the walk. Maybe only now, 30 years later, we fully realize how much courage it took for our Central and Eastern European partners to embark on their bold experiment without an existing blueprint, under economic circumstances that make our troubles today look relatively benign. But they had little choice, and neither do we. So let's learn from their experience and take courage from their example. Even if we do not yet know exactly what a carbon neutral economy looks like and how it will change our everyday lives. The EU Green Deal is ambitious and bold. And now we have to get to work to implement it and fund it. And at the same time, to reach out beyond our borders, to work together with other governments, regulators, private investors, financial sector, climate experts, and central banks from all over the world, to overcome the policy challenges and to make sure that we meet the Paris Agreement targets and tackle climate change in time. Let me stop here.
Okay, thank you, Governor. So you certainly put the gauntlet down, the challenge to the market participants. So let us turn straight over to Isabel and for response for the question, how do you respond to this agenda that you see evolving in Europe?
Thank you very much, Alex. Thank you, Governor Knott, for this really inspiring speech. It's noteworthy that you're the second Euro-assistant central bank governor this morning to indicate that it may be a good idea for the ECB to tweak its corporate bond purchase program to reduce its carbon exposure. So that's highly exciting. Look, in terms of responding to the speech, I agree 100% with pretty much every word of it. So I thought instead of trying to challenge it, I would touch briefly on 4 issues. First, how do we at BlackRock address and embrace this issue of sustainability? 2, how are we seeing the investor landscape change, and we're seeing very rapid change. 3, what is driving this? And 4, what else do we need from the official community, from the European Commission and other regulators? So let me begin with, since you mentioned it, Alex, in your introduction, the letter that our CEO, Larry Fink, wrote to corporate CEOs, the leaders of the companies that we invest in around the world on behalf of our clients, just a couple of weeks ago. This is not something that was done for the first time this year. It's something that we do every year now for 8 or 9 years. But it's true that in the last couple of years, we've put emphasis on sustainability. Last year, the message was climate risk is investment risk. And believe it or not, that was received as a controversial message in many parts of the world. This year, we went a step further in drawing CEOs' attention to the fact that the world is going to net zero. I think with the announcements we saw, particularly in the last quarter of last year, from the European Union, from Japan, Korea, China, and of course now the United States, there's now 127 countries around the world representing over 60% of carbon emissions that have made a firm commitment to aligning their policies with actually meeting the goal of reducing global warming to below 2 degrees. And that means, by and large, net zero by 2050. So it's no longer a question of opinion. The world is going to net zero. And so what we did with this letter to CEOs of companies is to tell them the world is going to net zero. How is that going to affect your company? Please tell us what you are going to do to contribute to this transition and to adapt to this transition. Because if you don't tell us this, it's going to be very difficult for investors to determine the value of your company, basically. And this is something we're going to put a lot of emphasis on in our investment stewardship activities. That is to say, the engagement that we have with a number of corporates, and we've in fact decided to really intensify our engagement with companies that account for the largest carbon emissions. As well, we have committed to publish the temperature alignment of all the funds and products that we make available to the public by the end of the year, whenever the data to do so is available. So that way, every investor will be able to decide for themselves if they want to align their portfolio with this goal of reaching net zero by 2050 and how to do it. So let me now turn to how the market is responding to this challenge of climate change. Here too, the developments, frankly, are enormously encouraging. When the COVID shock hit the world, the markets, every one of us last year, I think there was a real concern that climate change would be relegated to a second or third order issue, particularly for investors. And instead, what we've seen is a massive acceleration of allocations to sustainable funds. if you look globally at the landscape of sustainable funds and ETFs, the inflows last year reached over $280 billion. That's twice the amount of 2019. And that's in mutual funds, but we've seen this acceleration across the entire market. Just late last year, we surveyed institutional investors from across the globe, representing around 25 trillions of assets between them. What they tell us is, on average, they plan to double their allocation to sustainable investment solutions between now and 2025. Double from, on average, 18% today to 35%. And in Europe, it's much more, it's to 45%. So, Europe remains a leader. There's no question about that, but the other parts of the world are now beginning to catch up in earnest. Now, why is that important? Well, it's important because it means prices are going to adjust. And that is a key driver of this transformation, of this really increasing deployment of finance in support of the climate transition, is that the investment case is becoming clearer and clearer. It is becoming clearer in terms of the policy clarity that we have. And in that sense, the Green Deal is really enormously helpful, because finally investors are able to understand what is going to be the policy environment that applies to them. And they can get a sense of how company fundamentals, their earnings power, their costs are going to have to adjust. But secondly, the flows themselves are driving increasingly a premium to companies that are deemed better prepared for the transition, and penalizing those that are not prepared. And that is obviously very very helpful. As well, there is now far more investment solutions available to investors. We roughly doubled our offering of sustainable products last year. I think every other competitor is by and large doing the same. And so it's easier and easier for asset owners to deploy their capital in a way that is climate aligned. So in that sense, it's becoming increasingly clear to every investor who does their homework that climate change is not only a risk that needs to be taken very seriously, but frankly is also a huge opportunity. And we're seeing this in the way the flows are being deployed. So is everything perfect? No. What else do we need? I think the disclosure and transparency elements that Governor Knott mentioned are extremely important. And here again, the EU took a great pioneering first step with its effort to come up with a taxonomy that is very helpful. I would say, as a global asset manager, what we would hope to see, and frankly, capital markets are of course global, is a global standard. And here again, I was really encouraged to hear Governor Knott, place the European efforts squarely in a global context of the G20, the FSB, IFRS eventually. We ourselves have been vocal supporters of the TCFD and SASB frameworks as a basis for corporates to align their disclosures. It is obviously of paramount importance that disclosures across companies are comparable and ultimately as easily readable as financial information. So we're really pleased to see the direction of travel there. We hope we end up with truly global standards. Last thing I would say is this is still very early, and we're all very early. The data is evolving all the time. The knowledge and the understanding of what it's going to take to get to net zero is evolving all the time. And so whatever taxonomy and regulations we come up with, it's really important to not take the world as it is today as what it's going to be for the next 10 years. There's constant innovation. It's important not to discourage it. It's also really important to recognize that we're not in a position to say, this is brown and this is green and there's nothing in between. Actually, the vast bulk of the real economy and obviously financial markets is very much in between. It's neither so horrible for climate that it's going to need to be shut down entirely, nor completely green and contributing to the solution. It's somewhere in between. It's going to have to be transitioned. And so what we need is, you know, shades of green rather than very binary taxonomies. And last but not least, you know, there's a lot of focus on public markets. By that I mean, you know, listed stock exchanges and publicly issued bonds. But let's not forget private markets, because if they're not regulated, if they're not subject to, you know, similar transparency requirements, there is a risk that you're simply going to end up with, you know, finance to very brown activities going to private markets, and the world will not be better off for it. So complex issue, lots to do still, but definitely there's been a great acceleration of change in the right direction over the last 6 months, and we're hopeful it will continue. Let me stop here.
Okay, thanks so much, Isabel. Great to hear how engaged BlackRock is. And that leads straight over to Jean, I think. Jean, this idea of more types of gradations between green and brown emerging in the debt markets, is this something the regulation can accommodate now, or is this something the markets will need to innovate on? How do you see this greater divergence of different instruments, things like sustainability bonds and transition bonds? Does that mean the market is way ahead of what regulators can imagine?
Well, I'm sure Klaas can imagine all of this. So, and great speech, by the way. It's fantastic to see the work the Netherlands Central Bank has done over the last few years. Really, it brings a tear to my heart. You know, we have to welcome any instrument that combines capital with purpose in these difficult times we face. Really, all our capital should be being put to work to create a better world while paying dividends. And there's no reason why, as I'm sure Isabel would agree, it's not a contradiction. We now know that capital that addresses broader issues such as ESG will more often than not outperform capital that doesn't address those issues. That's the big learning of the last 20 years. I'm very supportive, very welcoming of any instrument that attempts to bring together these two issues, making sure they can pay my pension when I retire, and God knows how long, and giving a return to society at the same time, because of course a return to society will ensure I'm more likely to have my pension paid in a few years' time. A healthy and vibrant economy is what Europe needs. A healthy and vibrant society, a green society, is what I want when I retire, what we all want when we retire. These are not mutually exclusive issues. These are part of the same issue, is the first point. So one has to welcome all of those sort of things. 50 Shades of Green, yes and no. Let's be careful here, because in the promotion of 50 Shades of Green is too often an idea, anything that's vaguely green is all right. That's not true. As the IEA will tell us, if you invest in automotive plants for petrol-based cars that reduce emissions a bit, you are being counterproductive, because the emissions reductions we have to get from the transport sector to achieve our tough and necessary 2030 targets of 55% cut in 1990 emissions require us to shift to zero carbon vehicles very quickly. We cannot meet those targets unless we are appropriately ambitious. And that applies to every sector that we want to look at in relation to the Paris Agreement. So it's not that a little bit of green is good. We need to understand what the floor is, what the minimal amount to achieve is, and that's what the taxonomy is attempting to do. Now, of course, above that, of course, there's room for 50 shades above the minimum. Think of this as investment grade. We need investment grade green sorted out. Yes, if you invest in a zero net carbon building now, that's deep green, dark green, that's fine. If you invest in a pretty efficient building now, and the Dutch Central Bank has done a lot of work on promoting the right kind of investments in buildings in the past, then that's good, but not good enough for 2050. That's a light green. So we will get this happening. The market will figure this out. So the taxonomy doesn't aim or claim to solve the problem of 50 shades. It aims and claims to solve the problem of minimal requirements to play. Frankly, if you're not in the taxonomy in an area of relevance, I take Isabel's point, lots of areas of the economy are in between. We understand that. But take energy or transport, then I'm going to say from a moral perspective, I'm not going to say it from an economic perspective, really think hard about what you're doing, because this is something that is about the future for our children, and it will become an economic imperative as we see more incentives coming in from governments, fiscally efficient incentives, to push this transition. So we've had a tough year in 2020. Pandemic has been brutal, is still brutal. We know we have to build back, and we now agree in Europe, thank God, because in some countries we don't yet agree, that we have to build back better, and that we need to inoculate against future pandemics that the IPCC has been predicting for the last 30 years will be a feature of volatile climate change. There's a story behind that. The key point is it's not just mitigation, it's resilience. So when we look at the growth of green, and we discussed this in the taxonomy, we're looking at adaptation and resilience measures as well. We're looking at social measures as well. Not because social is just intrinsically good, but because there is a direct link between taking measures on the social agenda and the resilience of the European economy and European society going forward. In other words, we need to strengthen. And of course, you've seen this reflected in the Resilience Recovery Fund. It's a resilience and recovery fund. We need to build resilience. A third of it will go to green, but the other 2/3 will be resilience. So this is a very interesting debate here. US is now coming to it. I've been incredibly pleased by the announcements coming out of the White House in the last couple of weeks. They're on the right track. Their appointments have been fantastic. They will join Europe. China will join Europe. He's already. Xi Jinping has his own fight against the provinces. A report a couple of days ago into the National Energy Agency, an inquiry by the State Cabinet, the State Council, said that the National Energy Agency's licensing of coal-fired power stations in China was against Xi Jinping thought, quote unquote. Now, that is about as heavy-handed a measure as you can make from the central government to tell the provinces, get your act in line, we're looking at climate change. Each continent is having this challenge. We, of course, have our arguments in Europe. I'll come to those in a minute, but we're getting there. The taxonomy is about making it easy. It's also about identifying lower risk investments. If you're in the taxonomy, you can be pretty confident that you are reasonably insured against policy risk going forward, policy change risk. If you're not, you can't be sure. We've got to expand that definition over time. There are risks implicit in the taxonomy, which are now becoming visible as a result of this global discussion on taxonomy that's underway. For example, we've talked about the risk of leakage from the gas sector in the taxonomy, a critical issue. We now know that a little bit of leakage, 3% in the gas pipeline, can make a gas plant the same effective emissions level as a coal plant. We have not factored this in to our previous discussions in Europe around gas as a priority. This is a problem. We have other issues. We know that we're going to shift to hydrogen. There is a reasonable chance that we're going to get hydrogen the same price as gas by the end of this decade, in which case there are risk issues around investment in gas over the longer term that we need to bring to the forefront. And I'm going to say the work of the Network for Greening Financial System, or scenario planning, is a framework for us to start thinking about this. It's really important. There are many risks, electric vehicles and so on. That's the big discussion flowing on from the taxonomy. The taxonomy says, let's look at the science. Let's not look at the political constraint, which is what we've done for national climate change plans in the past. As the scientist says, we've got to do this. well, that's very difficult. What about we just do this, which is nearly good, right? Those days are past. We are now looking at the science and then looking at the political economy issues afterwards. And as part of that process, we're looking at the range of risks associated with not getting to the science, that's financial stability, instability going forward. And from investors' perspective, making the right picks ahead of the policy and technological change going through. So it is an extraordinary time. This year, the taxonomy will come to fruition, probably April now, everyone, sorry, running a little late. It will then go to the Parliament and come into action, and BlackRock will be looking in detail at it. It will have an impact. It is already having an impact. We have investors around Europe already looking to align their portfolios against the taxonomy. Banks. There is a live and necessary discussion going on in every sector about what is a minimal requirement to achieve the Paris Agreement and what isn't. This is the discussion that we have not had in the last 30 years adequately. It's underway as we speak. We will need to move to the next step. Much greater public-private engagement on how we go forward. We need risk taken out of this new sectors. We're not going to be able to do it with just market forces. We are seeing that. The Commission is doing stuff. In China, we have cheaper capital, the liquidity lending window of the central bank, if you post green bonds. Hungary's tried this. There's lots of things on the agenda. I won't say Klaus won't agree with some of these things. I fully appreciate. But the point is the discussion's underway about the nature of incentives that we take forward. It will happen, including green quantitative easing, as Christine Lagarde has said. And then we need to get on to the big job, which is how to get the world to create the green assets that will deliver us a sustainable future for our children. And picking up Klaus's point, that will be in emerging markets more than Europe. That will require partnerships with other countries and other regions that we have not seen adequately in the past. We have a good chance this year. At the end of this year, we will see Europe, China, and the US standing shoulder to shoulder with the same broad target, saying we are now working on climate change. That is a sea change in the last 18 months. We are now listening to the science in a way we have never listened to the science on climate before. This is a European strength. It is Europe that was the source of the Enlightenment. It was Europe that was the source of the scientific revolution. I'm saying that it is Europe as being the leader in this incredibly important shift to listen to the science and act now. Hey, that's a learning from the pandemic, isn't it? Listen to the science and act now.
Sean, thank you so much. Wonderful. Gives us a clear sense of the significance of this agenda. Right. Okay, let us, last but not least, move over to Philip from Restov for a perspective from a local, from a European capital market that has styled itself as a green exchange. Do you see investor interest mobilizing new projects, new investment types you didn't previously see? What potential do you see to really generate additional finance in this agenda?
Thank you very much, Alex. Thank you, Governor Not, for your speech, and where I have to admit that I agree with everything you said too. We like to compare the sustainable transition to climate neutral circular economies as a marathon. As a marathon, everyone has to run actually, and we are quite in the beginning of this marathon. And we all know that a marathon has certain stages, easier stages, more difficult one, and painful ones, and then the unforeseen ones. And one of the painful and unforeseen one was obviously the COVID-19 crisis, which somehow impacted the agenda we had foreseen for 2020. We don't know exactly the scope and the depth of the impact on the economies, on national budgets so far. What do we know is that we have an ambition, a target we have set by the Green Deal We know that we have a Sustainable Europe investment plan in place, and this investment plan does not only want to mobilize 1 trillion euros, but it was also to create an enabling framework and tailored support. And I believe that these two measures are also important to mention. So the investment plan relies on, and the government has said it, on capital markets, but also on banks, who to a large extent still finance the European economies. So I will come to the banks later and start with the capital markets. So what is the role of capital markets? Well, we believe it's twofold. It's one, it's bringing together the investors and issuers of sustainable financial instruments together and deliver them reliable and comparable data that's enabled them to make their sustainable investments. Both investors and asset managers need sustainability data, allowing them to analyze pre-issuance and post-issuance information. But those data is, for the time being, really tedious to collect. Now, when it comes to green issuers, what is the situations today? Now, I have to agree with Isabel. Issuance for investment funds, ETFs, and green bonds has gained a lot of momentum. We have seen issuance by sovereigns, by public international bodies, by development banks, by financial institutions, and corporates. And so global green issuance has risen in 2020. As you might know, we have in Luxembourg since 2016 a Luxembourg Green Exchange, and there we have now about 800 securities listed. So out of these 800 securities, we have roughly 300 sustainability bonds, 47 social bonds, and the issuance of social bonds has risen quite considerably last year, essentially due to the COVID-19 measures. And we have roughly 400 green bonds with a market value of 193 billion euros. And there we have seen a steep increase. If we look at the global fund flows, and this is already have been mentioned by Isabel, we have seen a sharp rise there too. So there's definitely a growing appetite that we see for green investments in financial markets. The greening of the economy entails new investment opportunities and new growth. So this is something we definitely see. Will it be enough to mobilize the 1 trillion set by the Sustainability Europe investment plan? Has to be seen, at least. And if we look at investment manager, we can look at the polls and see that there's a clear determination, as already mentioned by Isabel, to expect a convergence from non-ESG to ESG products, and that relatively soon. Where we see a little disconnect is when, while asset manager overwhelmingly agree on this convergence, only 14% of them stop launching non-ESG products. So there, we believe that there are more incentives to be needed. Banks play an important role. They, for the time, struggle a little bit with the risks related to ESG factors and the difficulties to quantify it. But as Governor Nott has said, this is something that will be tackled. So on the banking side, I believe that in the short term we will focus on to correct the assessments of risk, and in the medium to long term horizon we will probably see a more focus of the consistency in approaches. So to come back to my analogy with the marathons, we have different kinds of runners: experienced runner, less experienced runners. And this is the same when we look at the actors who actually have to participate in the transition, SMEs, corporations, financial institutions, and investors. They are different. They are different stages. They have different mindsets. A lot of them have still to learn. And this is why, and this has mentioned already, transparency is key, but also learning is key in that matter. And because what they all have in common is that they need a common set, an understanding of the common set of shared rules, of duties, and comprehensive structured and comparable information. So it is important that we have an investment plan for Europe. It is important that we have tools like InvestEU. It is important that we have the clear and detailed taxonomy now. It is important that we achieve now to have labels and standards that banks learn, and in order to be able to incorporate sustainability in financial advice. Sustainability benchmarks are very important to investors to help them to understand what their actually carbon footprint of their investments is. And of course, we need more sustainability in ratings and market research. This is clearly something we have been seeing. Now, we often the question is, yep.
Yeah, sorry, we have a lot of questions, so if
Okay,
you
so
can come to an end, and we'll have a Q&A then. You can come back to that.
No problem.
I didn't mean to stop you there, but
well, the last thing I wanted to say is the question we often get is the related legislation becoming too complex for market actors. No, we don't believe so. I think banks and financial institutions since the financial crisis have learned how to cope, of how to implement a lot of different types of regulations and prudential requirements. And I think they hope to welcome new legislation soon that gives them previsibility, and this is what the governor said too. They need a long-term outlook and see what is coming. This would be it.
Okay, thanks so much. Really encouraging to see how this translates into mobilizing finance in a major European market. So we have a lot of questions, really testament to your thoughts and insights here. Let me take them from the top and maybe start with one debate that's in a couple of questions here. One reads, are you in favor of a brown list that would sanction or penalize, I believe, brown assets rather than merely a green list as we now have it in the taxonomy? Maybe this is something that could go to the governor and possibly John.
Thank you, Alexander. I think this is a very pertinent question. Obviously, it's all too human that everyone wants to be the good guy and focus on what is actually to be promoted, which is green investments. But it's much more difficult to find people that are also willing to play the bad guy here, and that are the ones that are singling out actually the brown part of the list. So the simple answer to the question would be yes. I think definitely in the short run, we do not only need to know what is green, but it's even more pertinent, I think, that we need to know what is brown, and that we can put the policies in place to, well, penalize is a heavy word, but at least create incentives that these will be phased out as quickly as is reasonably possible. But I think that the general point has also been made by a couple of discussants that actually making the world too binary is also not helpful. I mean, it's a sliding scale, and I think everywhere on the scale, there's a part green, a part of it is brown. And obviously, if you go from one end to the other end of the scale, the brown dissipates and the green starts to dominate. It's much more helpful, I think, to think about this in a continuous function. But it is true that we also have to tackle things like agriculture, kerosene taxes, etc., that are more on the brown end of the spectrum, and cannot only focus on the positive investments that we have to make.
Okay, thank you.
Alexander, just to let you know that the taxonomy is working on a negative screen under the direction of the European Parliament. You'll see a draft coming out in mid-year, and there's a workshop about it, or initial webinar on the 24th of Feb. So it's a piece of work underway.
Okay, very good. So one more question on the international dimension, I believe. One that is currently our top score here reads, how to practically prevent production from moving outside of Europe to avoid the cost increase due to carbon pricing. That is the question, I believe, that sort of points at the broader problem that we are creating a fairly complex regime within Europe. What does that imply for investment flows? Maybe Isabel, would you like to take this?
Sure. Thank you. So look, I think there are two dimensions to this. One is effectively on the trade side, right? And you know, there's discussions around the carbon border adjustment mechanism, but from an investment side, I'm not sure actually that it's directly relevant, in the sense that, you know, if you buy a share in, okay, I'm not going to name names, but you know, a European company that has the possibility of producing anywhere around the world, you know, what we are hoping we're going to get through TCFD and all the disclosures that are increasingly being asked of companies, and certainly that we as an investor asked of companies, is we don't really care whether their carbon footprint is realized in Europe or in India or anywhere, as long as a global corporate, taking into account their entire operations, they are not playing by the rules, or they're not consistent with reaching net zero. The location of their activities is frankly irrelevant. So I think it's more a trade and industrial policy in a way than an investment issue.
Okay, thank you. So the couple of questions again on the transition issues. Are companies really prepared to have this binary jump from somewhere in between to a pure green? Is the taxonomy too prescriptive in really limiting to what John described as sort of investment grade, and do we not see a broader variety and quality of disclosure and technologies that are suitable for these classifications? And if I could throw in an additional question that's a bit further down the line, what does this imply for the funding of SMEs? Do we not cut off with this drive into green finance companies where transparency and disclosure is a much graver challenge, and companies that traditionally rely primarily on banks, and which may now be poorly placed to comply in a situation where already you know, the debt and the financial situation coming out of this pandemic puts them in a slightly distressed situation. Maybe Jean, could you respond to these?
Well, first, the taxonomy is a labeling scheme. It's not a ban. You know, it's not saying thou shalt not invest. It simply says, if you're going to invest and you want to indicate that your investment is in line with these environmental objectives, here's a list. And it provides comparability. So we can finally compare BlackRock and State Street Global and Amundi's claims to sustainability, which are good claims, but we haven't had the mechanism to compare in the past. So look, let's just be clear about what it is. This is not about saying thou shalt not. This is about saying, if one wants to, here's a rule set to call it sustainable. That's what it is. Now, it's also much more complicated than going green. I mean, look, in the EU taxonomy recommendations, we included the retrofit of gas pipelines to make them hydrogen ready. And we've seen 2 bonds issued in the UK and in Italy, where gas pipelines basically plasticizing them to make them hydrogen ready, were included and said to be in alignment with the taxonomy, and they were. And that's an example of a stepping stone investment. But it does require us to be confident about the nature of the transition to the Paris Agreement in all of these sectors before you can make those kind of calls. We've only just started this work in the taxonomy, but there are many areas where we have a moving goalpost. Buildings in the TEG recommendations, and will be in the Act finally, is an example where there's a moving goalpost shifting towards net zero carbon eventually, and to drive the sector. Same in metals, manufacturing, and so on. So we very much embrace the concept of transition. We just need to ensure that the claims are suitably confident or suitably solid, so that when we get to where we've got to get to, we really get there and we don't undershoot dramatically, which has been the story of the last 30 years. In terms of SMEs, it is challenging. What we have done in some areas, like in the building sector, is identify a whole list of providers that we call include, whether or not the building sector, especially whether or not the building is green. If you're a triple glaze or double glaze windows manufacturer, you're counted as sustainable. You just got to show that's what you produce. If you install, you're counted. So that opens up a large universe of SME lending for the likes of the European Investment Bank and commercial banks that can be brought in. So we're seeking to tackle this agenda, and we'll expand that agenda around SMEs. And then we have enabling investments. So we're also talking about things like grid investments, which NGOs don't think are green, but actually if we're electrifying Europe, these are essential investments going forward. Or mining, we're looking at strategically important minerals for the transition. So there's a hell of a lot in there. It is a very rich soup that we've created.
Okay, wonderful, thank you. Now, so we're running out of time. Could I ask each of you to give just a 1 minute summary of what you look for in the Brussels agenda, or the collaboration of European governments and central banks, and what is the main deliverable from Brussels? Let me just throw in to motivate that one more question here from a couple of participants. Are we offering too much? Are we requiring too much of the financial sector now that additional aspects of sustainability, such as the biodiversity, social aspects, also come into this ESG agenda? And is this not really a confusing picture that emerges for investors and bank depositors? But give us your ideas of the main policy initiative that will be needed this year. Let's go in reverse order and give a brief comment from Philip, please.
Well, as I mentioned, it's a marathon. We are at the beginning. A lot of people and companies and institutions are confused. We need clarification on a number of levels. It's about learning. It's about national states implementing what has been decided by them on a European level, implementing them in their Agenda 2030, and if possible, by taking, as Governor Knott said, everyone on board.
Great, thank you so much. Jean.
Investors now understand the forward risks we face and want to act. We've heard that from Isabel. We hear it again and again and again. But moving as quickly as we need to move cannot be just left to the private sector. We have to have a close, tight, collaborative working relationship between the public and the private. When we're looking for the action plan, we need to look for clues in that. I believe we'll get them. We need to look at risk mitigation. We need to look at regulatory steps. We need to look at a wide range of things that will ensure that investors responsible for our pension funds can move in a financially sustainable manner as well as an environmentally sustainable manner. That's the opportunity for us this year. I think we'll seize it.
Okay, thank you, Jean. Isabel, what do you look for in this collaboration between the private and the public sector?
I think the key is policy clarity so that investors can put a reasonably accurate price on, activities that help the transition and those that hinder it or just do not take part. And if you have the right policy incentives, not in the sense of subsidies or things like that, but you have the right price incentives and you have enough transparency and clarity about the direction policy, then markets will allocate capital in support of the goals of the transition. There won't be any need for any kind of heavy duty or highly formalized partnerships. Just set the right price incentives.
All right, very good. Thank you. And Governor, your closing thought.
Yeah, thank you so much. Well, as a previous marathon runner, I want to bring in here the feature that running negative splits, which means that you run a faster pace in the later parts of the marathon than in the earlier parts, that is something that very few people are capable of. And for most, let's say, normal mortals, time will go up during the course of the marathon, i.e. it is important to start as early as possible and not to expect or at least make the false assumption that you can still catch up during the second half of the trajectory. And in that context, I think this pricing, I think we all agreed on this panel, is really crucial. That we get the incentive right as quickly as possible, that the emission trading system gets expanded as quickly as possible, that excess emission rights get subtracted from the markets so that the pricing truly becomes reflective of the externality that is created, and that national governments then take care of the ERS, the parts, the sectors that are left out of the ETS. And then my second point, I already mentioned it, global cooperation is really key. You can think about border adjustment mechanisms, etc. I do think that there's a plethora of complications there with WTO rules, etc. But my overarching point, it would be so much better if we could really bring in everybody in the world. And I think the more large regions will join in, the more difficult it will be for the few remaining to opt out. And that would be a far superior solution than having to think about border adjustment mechanisms, etc. Okay,
Thank you so much. Thank you to all four of you as our speaker and panelists. Let us wish each other well for this further marathon. I believe a good distance is yet to come, and we certainly hope to stay in touch with all of you and all in the audience and accompany this with further work in Bruegel. Thank you again, and have a good rest of the week, and see you soon, I hope. Goodbye. Thank you.
Goodbye. Bye. Thank you.
Thank you so much. Bye-bye. It was a pleasure.
Bye.